Imagine paying taxes on crypto profits you haven't even sold yet. You bought Bitcoin at $20,000, it pumps to $100,000, and suddenly the tax man demands $28,000 in cold, hard cash. You don't have the cash, so you're forced to sell your Bitcoin just to pay the bill. Now, for years, this was just a scary campfire story we told ourselves during bear markets. But, that story has just become a reality.
This is our reality now.
The Netherlands has just passed legislation taxing unrealized gains at 36%, and it takes effect in 2028. This isn't a theoretical anymore. Paper profits could trigger real tax bills, forcing mass sell-offs and potentially crashing the market. Welcome to the new era of wealth confiscation. But is this just a Dutch problem, or is it the start of a global trend that could end HODLing forever? And more importantly, how can you protect your portfolio from this liquidity nightmare? That is exactly what we are diving into today. My name is Nick, and you're watching The Coin Bureau. Now let's look at exactly what happened, because the details are terrifying. On the 13th of February 2026, the Dutch House of Representatives approved the, quote, Actual Return in Box 3 Act. The bill passed with 93 votes in favor, which is a comfortable majority. So, what does this law actually do? Well, starting on the 1st of January 2028, Dutch residents will be taxed at a flat rate of 36% on the actual returns of their investments. And here's the kicker. For assets like stocks, bonds, and, yes, cryptocurrency, actual return includes capital growth, even if you haven't sold. And that means if your portfolio goes up in value during the year, you owe 36% tax on that appreciation. It doesn't matter if you're still hodling or if you plan to hold for 10 years, the government treats that paper gain as income. But it gets worse. The law explicitly exempts real estate and startup shares from the unrealized gains tax. Those assets are only taxed when they are sold. So, if you own a bricks and mortar building, you're fine. But if you own digital property, like Bitcoin, you get hammered. It's a clear double standard that punishes liquid assets and innovation. Now, you might be wondering, why on earth would they do this? Well, to be blunt, they didn't really want to. Even the lawmakers who voted yes admitted this isn't ideal. They are basically desperate to plug a €2.3 billion annual revenue hole left after the Dutch Supreme Court ruled their previous tax system was illegal. So they rushed this through as a, quote, bridge solution. A very expensive, portfolio-destroying bridge. But why does this actually matter if you don't live in the Netherlands? Well, because ideas like this have a nasty way of spreading. We all know that governments worldwide are drowning in debt. Global debt hit record highs in late 2025, sitting near $346 trillion. Politicians are looking for any untapped revenue source they can find, and unrealized gains are the golden goose. Remember the Biden administration's 2025 budget proposal? They pitched a 25% minimum tax on unrealized gains for Americans worth over $100 million. Now, that proposal effectively died on the vine, especially with the recent political shifts. But the idea is out there. It's a zombie policy that keeps coming back to life. California just floated a billionaire net worth tax. Illinois considered mark-to-market taxation. The Netherlands is just the first domino to actually fall. And if it works there, meaning it raises enough money without causing a total economic collapse, you can bet other finance ministers will be taking notes. But here is the real nightmare scenario for crypto investors. It's called the liquidity death spiral. Imagine you hold Bitcoin worth $100,000. You bought it cheap, maybe at $20,000. Under a 36% unrealized gains tax, you have an $80,000 gain. And that means you owe roughly $28,800 in taxes. But you haven't sold a Bitcoin. You don't have $20,000 in cash lying around. So what do? You have to sell some Bitcoin to pay the tax. Now, multiply this across millions of investors. Every tax season, everyone is forced to sell assets at the same time to pay taxes on paper profits. This mass selling drives down the price. And because the price is dropping, liquidity dries up. It creates a feedback loop where the tax itself triggers the crash it was designed to capture. And for crypto, it gets even worse because of volatility. We all know crypto has 80% drawdowns. It's part of the game. But imagine this scenario. It's the 31st of December 2027. We are in a massive bull run, we hope. Bitcoin hits $150,000. You are ecstatic, even despite the fact that you owe tax on those massive gains on the 31st of December snapshot. Then January 2028 rolls around. The market corrects and Bitcoin crashes to $60,000. You are now holding an asset worth $60,000, but you owe taxes based on a value of $150,000. You could easily owe more in taxes than your entire portfolio is currently worth. You are underwater on the asset, and you owe the government money for the profits that have evaporated. Sure, you can carry those losses forward to future years, but that doesn't help you pay the bill due now. It is mathematically ruinous. Now, before we get into how you can protect yourself from this, and there are ways, I want to mention something important about staying informed. Policies like this can pop up overnight, and if you aren't paying attention, they can wreck your strategy. And that is why we have the Coin Bureau Telegram channel. It's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. So sign up today using the link down below or scanning this QR code over here. Okay, back to taxes. Now you might be thinking, if they pass this law, I'll just leave.
Easier said than done.
The Dutch proposal includes something called a, quote, protective assessment or conserverende aanslag. Basically, if you try to emigrate, they calculate the tax on your unrealized gains right then and there. It's an exit tax. They might let you defer payment, but the debt hangs over you indefinitely. It's capital controls disguised as tax policy, and history shows us exactly how this ends. In the 1970s, the UK had a top tax rate of 98% on investment income. The result? The brain drain. Anyone with talent or money left the country. The Rolling Stones moved to France. Michael Caine hot-footed it to the US. It didn't raise revenue, it destroyed the economy. Sweden tried a wealth tax. What happened? IKEA founder Ingvar Kamprad moved to Switzerland. Sweden eventually repealed the tax in 2007 because it was costing them more in capital flight than they were raising in revenue. France had the ISF wealth tax. It caused an exodus of 42,000 millionaires and 35 billion euros in capital flight. They repealed it in 2017. The lesson is clear. Wealth is mobile. If you try to tax it before it's realized, it leaves. The Netherlands is set to learn this lesson the hard way. So, what are sophisticated investors doing to prepare? Because you can bet they aren't just sitting there waiting to get wrecked. First, we are seeing a migration to crypto-friendly jurisdictions. Portugal used to be the go-to with zero tax, and while they have tightened the rules, holding crypto for more than 365 days is still generally tax-free for individuals. And then you have the UAE. Dubai has zero personal income tax and zero capital gains tax. It's becoming the capital of the crypto world for a reason. And of course, we can't forget El Salvador. Despite some changes regarding legal tender status, they still exempt Bitcoin transactions from capital gains tax. There is also a darker shift happening. This kind of legislation accelerates the move underground. We've seen privacy coins like Monero and Zcash putting in serious moves recently. Monero hit an all-time high of nearly $800 in January 2026. Why? Because if governments try to tax what they can see, people will move what they have to where people can't see them. However, this is a dangerous game. The EU's MiCA regulations and the US Treasury are cracking down hard. Major exchanges have delisted privacy coins. We are seeing a bifurcation of the market, the compliant white market and the dark shadow market. The Dutch law creates a massive incentive for that shadow market to grow. Ironically, by trying to squeeze every cent out of investors, they might end up driving the economy into places they can't reach at all.
What's the verdict?
To be blunt, for Dutch investors, HODLing is set to get a lot more expensive. The law fundamentally breaks the mechanics of long-term investing. It will force you to trade, to sell, to churn your portfolio just to pay the bills. But globally, the resistance is strong. The fact that this law passed with such reluctance, and with a new coalition government already promising to try and reverse it, shows that even politicians know this is a bad idea. The unrealized gains tax is an existential threat to property ownership. Taxing wealth you haven't realized is taxing potential, not income. It forces you to sell the very thing you are trying to build. But here's the silver lining, guys. Capital goes to where it is treated best. As the Netherlands and potentially other desperate nations tighten the screws, places like the UAE, Singapore, and perhaps a more pro-crypto US administration will absorb that wealth. The choice is coming sooner than you might think. You need to look at your portfolio and ask yourself, if my country passed this law tomorrow, would I be solvent? If the answer is no, it might be time to start drawing up your plan B. But what do you think? Is the Dutch law a sign of things to come, or will it collapse under its own weight like the wealth taxes of years past? Let me know in the comments down below. And if you want to know more about the best countries for crypto investors, check out that video right over here. And if you want to see how the US election actually impacted crypto taxes, you can check out that video right over here. Okay, that's all from me today. Thank you guys very much for watching, and I'll see you again soon. This is Nick, signing off.